Permian Resources, ticker PR, delivered a massive beat on the street consensus for their Q2 2026 earnings. I mean, right out of the gate, top-line revenue came in at $1.86 billion.
Yeah, which is a 55.1% year-over-year increase.
Right, absolutely crushing the $1.66 billion consensus estimate. Adjusted EPS came in at 69 cents, beating the $0.57 consensus, and GAAP diluted EPS landed at $0.93.
And looking at guidance, they actually raised full-year 2026 oil production to 199.0 thousand barrels per day.
Which is a 10% jump over 2025.
Exactly. And they updated the full-year cash CapEx guidance to a midpoint of $1.95 billion.
Now, the stock reaction was a bit of a roller coaster for anyone watching. Shares slipped 3.46%, down to $19.79 during the regular session.
Mostly due to that broader oil market pullback we saw.
Yeah, exactly. But then it popped 2.53% in after hours, trading up to $20.29, and eventually rallied nearly 5% over the next few days as the market actually digested the cash flow numbers.
Because that's where the real meat of the report is.
Right. Honestly, while pulling in huge top-line revenue during a strong commodity cycle is flashy, the real story here for retail investors is hidden entirely in how management squeezed every possible cent out of their margins this quarter.
It really is. I mean, in the E&P sector, revenue's great, but what separates top-tier operators from the rest of the pack is how efficiently they translate that top-line revenue into actual retained cash.
Yeah.
And the efficiency metrics Permian Resources put up this quarter are genuinely hard to ignore.
So let's get into those. Total average production for the quarter was 376.4 thousand barrels of oil equivalent per day.
With oil production specifically hitting 198.1 thousand barrels per day, so up 12.2% year over year.
But here's the number that just jumps off the page for me. They generated a record $751 million in adjusted free cash flow for the quarter.
And the most important part of that $751 million figure is the margin. Their free cash flow margin clocked in at an incredible 53%.
Wow.
Yeah, some historical context. That is up from 44.3% in the same quarter last year.
I want to pause on that 53% margin because I don't think people fully grasp how wild that is for an oil driller. I mean, think of Permian Resources as a highly optimized, ruthless factory, right?
Right.
For every single dollar that comes through the factory doors from selling oil and gas, after they pay for the raw materials, the labor, the machinery maintenance, and the corporate overhead, they are keeping more than 53 cents of it in pure cash.
It's unheard of.
My brain immediately goes to software companies when I see margins like that. Not heavy industry. I can't figure out how a heavy machinery business doesn't eat up 80% of its cash just maintaining its equipment. What am I missing here about their specific operations?
You aren't missing anything, really. It's exceptionally rare. The E&P industry is inherently capital intensive because of decline curves.
Right.
When you drill a new well, the production spikes initially, but then it naturally declines over time. To maintain your total production volume, you constantly have to drill new wells just to replace the production loss from the older ones.
Yeah, so historically, a lot of operators would burn 80, 90, or even 100% of their operating cash flow just to stay flat.
Exactly. So retaining 53% is free cash flow.
Which is cash they can actually use to pay dividends or buy back stock.
Right, or retire debt. It's
Yeah.
a massive outlier. It points to incredibly high-quality rock in the Delaware Basin, meaning the wells produce more for longer, and a highly disciplined approach to capital spending.
Yeah.
Just to put a bow on how significant this is, that $751 million generated in Q2 alone exceeded the company's total free cash flow generated in all of 2023.
A whole year of cash flow generated in just 90 days. But seeing numbers like that makes me think, it doesn't just happen by accident or by just having good rock.
No, not at all.
You don't hit a 53% free cash flow margin by putting your operations on autopilot. Management clearly had to make some serious real-time maneuvers to hit that number.
They did. And the biggest maneuver they made was essentially dodging a massive financial trap. This quarter was defined by a severe dislocation in the natural gas market, specifically at the Waha hub in West Texas.
Right, the Waha hub pricing. During Q2, Waha natural gas prices were not just low, they were severely negative.
Deeply negative.
The average price was negative $3.14 per McFIF, and it traded as low as negative $9.52 per McFIF. Let me just translate that jargon for everyone listening. McFIF stands for 1,000 cubic feet of natural gas. So for every 1,000 cubic feet they pulled out of the ground, the market was demanding they pay nearly $10 just to get rid of it.
Which is just, it's a mind-bending concept for most people. Imagine running a business where you pull a product out of the ground and the market tells you, We won't buy it. In fact, you have to pay us to take it away.
Yeah.
In the Permian Basin, natural gas is often what we call associated gas. It's a byproduct that comes up when you drill for oil.
You're aiming for the oil, but the gas just comes along for the ride.
Precisely. And you can't just vent it into the atmosphere due to environmental
Yeah.
regulations. But the pipeline capacity to transport that gas out of the basin has been severely constrained.
Right. So when those local pipes fill up, the local price crashes below zero because producers are desperate to offload it so they can keep pumping the lucrative oil.
Exactly. So, facing that bottleneck, management made a highly tactical decision. Instead of paying counterparties to take that gas, they actively curtailed their natural gas production.
They choked back what they call their high GOR wells, right? The ones with a high gas to oil ratio.
Yeah, and instead, they accelerated high-return workovers to capture the high oil prices, which they were realizing at an average of $97.81 per barrel.
And the workovers are key here. A workover is when you go back into an existing well to perform maintenance or stimulate it to instantly boost production rather than spending the massive capital required to drill a brand new well.
Right. They looked at the market and realized it made 0 sense to run their machinery, wear down their infrastructure, and pay negative prices on the byproduct.
They pivoted their field operations instantly to prioritize the asset generating nearly $100 a barrel. I look at this like a farmer who has two crops. One is a cheap crop that the market is suddenly demanding you pay them to take off your hands,
Yeah.
and the other is a high-value cash crop. Permian Resources essentially let the cheap crop sit in the field so they could focus every single tractor, every farm hand, and all their fertilizer entirely on the high-value cash crop.
That's a great way to think about it.
But I have a hard time believing this is a permanent solution. Wait, leaving your gas in the ground sounds great in theory, but they can't just choke back these wells forever without damaging the long-term reservoir pressure or the eventual output of most wells, right? Is this just a localized Band-Aid?
It is absolutely a bridge strategy. You're spot on. It is not a sustainable long-term operating model,
Right.
but it was a necessary and highly effective Band-Aid for this specific quarter. Management noted that new pipeline capacity, specifically the Matterhorn Express pipeline, is expected to come online in the second half of this year. That infrastructure is going to relieve the regional bottleneck, allowing gas to flow freely out of the Permian to the Gulf Coast, which should normalize those Waha prices back into positive territory.
Got it. So choking back the wells was temporary, but it saved them millions of dollars in negative pricing penalties and allowed them to artificially boost their margins during a localized crisis.
Exactly. It perfectly explains the margin piece.
So while management was in the field playing defense with the natural gas pipelines, they were simultaneously taking all that saved cash and playing offense in the boardroom. They deployed that record free cash flow directly into inorganic growth.
Which is what led to them raising their forward guidance.
Right. And this brings us to their ground game, which is arguably their biggest competitive advantage in the Delaware Basin right now. The numbers on this ground game are frankly fascinating.
Oh, yeah.
Year to date, Permian Resources has spent $1.05 billion on approximately 190 off-market smaller transactions. Through this, they added 54,000 net acres and 20,000 net royalty acres.
And that includes the Ward County bolt-on acquisition, which was already producing 5,000 barrels of oil equivalent per day the moment it closed.
Yeah, but the key to understanding this strategy is looking at the valuation on those deals. These were not premium-priced mega mergers.
No, they executed these 190 transactions at highly accretive valuations. We're talking roughly $13,000 per net acre, with a weighted average signing price of roughly $72.50 per barrel of WTI.
Meaning they bought this acreage assuming oil was only at $72.50, and since they are realizing much higher prices, near $100 a barrel like we just talked about, the payback period on these acquisitions is incredibly fast.
Extremely fast.
To me, the strategy feels exactly like Moneyball. Instead of going out and signing the single most expensive, flashy free agent on the market,
Which in this industry would be a massive multi-billion-dollar corporate merger where you have to pay a huge premium to the target shareholders.
Exactly. Instead of doing that, Permian Resources is focusing on 190 small, proprietary, off-market deals. They are finding undervalued assets piece by piece. But I have to challenge this. Managing 190 tiny acreage deals sounds like a bloated back-office disaster waiting to happen.
Right.
Why wouldn't a super major like Exxon or Chevron just swoop in and buy these plots? Is the juice really worth the squeeze on a 50-acre plot?
That's exactly why this is a competitive advantage. It definitely requires a specialized back office and a highly localized land team. You have to understand that in Texas, mineral rights are often heavily fractionalized.
Right, right.
A single plot of land might have dozens of owners because the rights have been split among family members over generations. A massive supermajor has strict corporate hurdles and layers of legal review. For them, a 50-acre or 100-acre acquisition just doesn't move the needle enough to justify the legal and administrative headache.
It's just too small for them to care.
Exactly. But for Permian Resources, as a more nimble, pure-play operator, this is their bread and butter. Because they are willing to do the heavy lifting on 190 small transactions, they avoid the competitive bidding wars that drive up prices on large corporate acquisitions.
That makes a lot of sense.
They have built a team specifically structured to process high-volume, low-acreage paperwork efficiently.
And the result of that heavy lifting is undeniable when you look at the math. By acquiring these small adjacent tracts of land, they increase their average working interest on their new wells to over 80%.
Let's break down the mechanics of working interest, actually, because it's crucial. Working interest is simply the percentage of ownership a company has in a specific well.
Okay.
If you own 60% of a well and another party owns 40%, you pay 60% of the drilling cost and you keep 60% of the oil.
Right.
By using this ground game to buy up the remaining fractional ownerships in the acreage immediately surrounding their existing operations, they bump their average ownership to over 80%.
Which means they get to keep more of the oil coming out of the hole in the ground they were already going to drill anyway.
Exactly.
And that explains the guidance raise. That is exactly why they were able to raise their full-year production guidance to 199.0 thousand barrels of oil per day, while actually spending 1% less capital than they projected for 2025.
Yeah.
They aren't going out and drilling a bunch of new, expensive wells. They just own a larger slice of the wells they are already drilling.
It is the purest form of capital efficiency. The drilling rig is already mobilized, the completion crew is already hired, the pipeline infrastructure is already laid.
Everything is already in place.
Right. By acquiring that extra working interest, the operational friction is essentially zero. You leverage all your existing sunk costs, but you extract more net barrels to your own balance sheet.
But, deploying $1 billion into these micro acquisitions carries immense risk if oil prices suddenly tank. We've seen cyclicality destroy companies in this sector before.
Oh, absolutely.
So how are they shielding themselves from that exact scenario? What does their risk profile and cost structure look like right now?
Well, in an inflationary environment, keeping costs under control is the primary defense mechanism. Management was very transparent about facing inflationary pressures, particularly on diesel fuel, to run the equipment and the steel casing used to line the wells.
But they are actively offsetting those material costs through drilling efficiency gains, specifically by drilling longer lateral wells. They are averaging about 11,000 feet on their laterals right now.
And the financial mechanism of a longer lateral is fascinating. Once you drill down vertically a mile or two, you curve the drill bit horizontally to follow the oil-bearing rock layer.
Right.
At 11,000 feet, you are pushing that horizontal portion out over 2 miles.
So you are effectively tapping twice as much oil-bearing rock from a single vertical hole.
Exactly. You only had to pay the massive upfront cost to drill the vertical portion once, but you are exposing exponentially more rock. It aggressively drives down the break-even cost per barrel of production.
And it clearly shows in their numbers. Their total controllable cash costs are being maintained right in that tight, highly profitable window of $7.15 to $8.15 per barrel of oil equivalent.
That is a fortress-level cost structure.
Yeah. And speaking of defense, we have to talk about their balance sheet. Their leverage is remarkably low at 0.5x net debt to EBITDAX. And just for clarity for those listening, EBITDAX is essentially their core cash earnings before exploration costs are factored in.
To put that 0.5x leverage ratio into perspective, anything under 1.0x in this industry is generally considered very healthy and conservative.
Huh.
At 0.5x, their balance sheet is practically bulletproof against short-term commodity price swings.
And they utilize that record free cash flow from Q2 to get even stronger. During the quarter, they aggressively retired debt. They redeemed $875 million in legacy Earthstone notes.
Yeah, that was a great move.
Specifically, they took out the 8.1000% notes due in 2027 and the 9.875% notes due in 2031. By wiping out that expensive legacy debt, which I assume they inherited when they acquired Earthstone.
We did, yes.
Right. They instantly saved the company $75 million in annual cash interest expense. And they did this while still maintaining their $1.16 quarterly base dividend, which is a $1.64 annualized payout, giving investors about a 3.1% yield.
Retiring debt yielding nearly 10% is one of the smartest, lowest risk uses of capital available to any management team right now.
I want to dig into the safety aspect of that because it's critical. Beyond just saving 75 million bucks a year, how exactly does retiring 9.875% debt physically change the math for this company if, say, oil drops to $50 a barrel tomorrow?
It fundamentally changes their break-even math.
Uh,
Interest expense is a fixed mandatory cash obligation. Your revenue is entirely variable based on the global price of oil.
right.
In a cyclical industry like this, your biggest existential threat is a sudden, prolonged drop in commodity prices. If oil drops to $50, heavily indebted companies face an immediate liquidity crisis because their interest payments remain exactly the same, but their revenue just got slashed in half.
They get caught in a squeeze.
It's exactly. By taking $75 million of fixed, mandatory cash obligations off the table every single year, Permian Resources significantly lowers the oil price required to keep the lights on and the dividend flowing.
That makes total sense.
It provides a massive buffer. It transforms the company from one that has to constantly sprint just to service its debt into one that can comfortably jog through a commodity down cycle and still reward its shareholders.
So if we pull all these threads together, we have a company with a 53% free cash flow margin operating like a highly optimized factory. They're playing a grueling, localized game of Moneyball in the Delaware Basin to increase ownership in their own wells without increasing their capital expenditure.
Yeah.
And they're taking the windfall from that efficiency to lock in guaranteed 10% returns by paying off expensive legacy debt, fundamentally lowering their break-even point.
And they achieved all of that while navigating a localized market crisis where they literally had to dodge negative pricing on their natural gas byproduct. It's a textbook example of tactical, real-time execution.
Which brings us to the most fascinating forward-looking question for you to consider as you digest this earnings report. If Permian Resources can generate a record $751 million in free cash flow in a single quarter, while literally choking back their natural gas production because the pricing was deeply negative. Wait, I shouldn't say literally, but you get what I mean.
I do.
What happens to their cash flow profile when that new Matterhorn pipeline capacity finally comes online and natural gas flips back from being a costly liability into an actual revenue stream?
That is the exact catalyst the market is trying to price in right now.
It's a massive inflection point to watch out for in the back half of the year. Make sure you follow the show for your daily earnings coverage so you never miss a deep dive like this.